If you've been attempting to short the local tops in the crypto market over the last few weeks, you've likely watched your portfolio bleed. You take a position, anticipate the pullback, and immediately get whipsawed by a violent wick to the upside. Market makers utilize these rapid price swings to hunt retail liquidity, effectively converting short seller stop losses into the very buy orders needed to sustain the larger trend. Today, we are laying out the mechanical framework for trading alongside these market makers. We have identified the specific trigger levels for an impending short squeeze that is currently setting up to rip through the market. We will start by mapping the critical resistance boundary on Bitcoin, then cascade those exact mechanics down into the breakout setups for Ethereum, Solana, XRP, and Chainlink. Surviving this volatility requires abandoning retail assumptions. You must adopt the logic of large-scale market participants and trade with the overarching momentum, or you risk becoming the exit liquidity for those who do. This line chart shows the S&P 500 breaking forcefully past its historical resistance ceiling and pushing into new all-time highs. Traditional equities are currently in a defined bull market. Understanding this macro momentum is crucial because Bitcoin rarely sees a prolonged catastrophic crash while traditional equities are in an aggressive expansion phase. While retail traders often focus on isolated crypto charts, professional desks analyze the interconnected flow of capital across all asset classes. The relentless upward pressure in the S&P 500 provides a structural floor for crypto. This correlation currently neutralizes the threat of localized bearish news turning into a sustained downward trend. Aligning your bias with that macro stock market momentum is the first step in this analysis. Until equities show a reversal in their high timeframe structure, the path of least resistance for Bitcoin remains upward. This split-screen comparison illustrates Bitcoin's conflict. On the left, the weekly supertrend shows bearish momentum. On the right, the 3-day chart reveals a sharply rising relief rally. The battleground is the $76,000 mark. We need a confirmed breakout closing entirely above that boundary. If we get that confirmation, the structure shifts. The next massive magnetic level for price sits $10,000 higher, targeting the mid-80K range, specifically around $86,000. Clearing $76,000 would invalidate the lower high structure that has dominated the weekly chart for months. This pivot point signals that the structural resistance of the previous bear trend has finally given way to a new expansion. This liquidity heat map shows exactly where retail traders are vulnerable. We have massive, dense clusters of short positions pooling directly between $76,100 and $76,300. By crowding into short positions at a major resistance, these traders are creating fuel cells for the market. When price pushes into that zone, forced liquidations trigger automatic buy orders, driving the price even higher in a classic short squeeze. You might see a bearish divergence forming on the 4-hour RSI, but that is a temporary momentum cool-off. It is a brief setback in a defined upward channel, rather than a breakdown of the trend. If the market rejects and pulls back while absorbing that overbought signal, our support boundaries sit first at $73,600, with a secondary floor resting between $71,000 and $72,000. But the overarching reality is clear. By betting heavily against the trend right at a breakout point, retail traders are providing the exact financial fuel required to liquidate their own positions. Mapping perfect resistance targets is useless on sub-tier exchanges. Those platforms are mathematically designed to hunt your stop losses the second volatility spikes. Profiting from a violent short squeeze requires a high-reliability trading platform. You need precise order routing to ensure your fills happen without suffering devastating slippage when the market moves thousands of dollars in seconds. That is why utilizing an exchange like Novava provides an immediate advantage. By using the partner link below, you can unlock deposit bonuses up to $10,000 in withdrawable USDT with no KYC restrictions. Accurate analysis is wasted if the exchange can't handle the order flow. To capture the full move of a squeeze, your trading environment must be as robust as the technical setups you're hunting. Applying this logic to Ethereum, the chart identifies a massive resistance ceiling sitting directly at $2,400. A confirmed break above that line alters the chart's math. It opens a technical void with zero historical friction, clearing a direct path straight up to $2,800. Until that breakout is confirmed, we must respect the immediate downside risk. Any short-term pullbacks must be caught by the support net resting between 2150 and 2250. Ethereum is currently behaving like a compressed spring. It is perfectly aligned to trigger violently, waiting for Bitcoin to clear its own major hurdle first. We see similar compression across major altcoins. XRP successfully defended its $1.30 support floor, but it is currently struggling against a dense resistance block sitting between $1.45 and $1.47. Solana has been trapped in a sideways range for nearly 3 months. Right now, it is experiencing a short-term overbought rejection, exactly at its major boundary of $88.60 to $90.60. For Solana to maintain its underlying bullish structure, the support flip at $86 must hold perfectly on the high timeframe closes. Chainlink presents a high-risk technical setup, currently struggling at its $9.50 to $10 resistance zone. However, if it secures a confirmed close above $10, it targets an aggressive push towards $12. Across the board, every major altcoin is tightly compressed against resistance. They are all loaded, waiting entirely for that macro signal to ignite. The primary directive is simple: never front-run an unconfirmed breakout, but never actively bet against a proven macro bull trend. Patience is your greatest leverage. Wait for the confirmed 3-day candle close above resistance, and let the liquidated retail shorts provide the momentum for your entries. Securing entries at the point of breakout is only half the battle. Managing your risk after entering a high volatility trade is what separates profitable whales from retail plankton. To learn the risk management frameworks required to protect those profits, click the video on your screen right now. We break down the institutional rules necessary for surviving these specific market conditions. See you there.